Two people. Both start with $10,000 sitting in a savings account earning 0.5% interest. One of them leaves it there for 20 years. The other learns how to move that money into investments, step by step, without gambling it away. 20 years later, the saver has about $11,000. The investor has closer to $40,000, sometimes more. Same starting point. Same amount of risk tolerance. The only difference is that one of them made the transition from saving to investing and did it the right way. That's what this script is about. Not get rich quick. Not put everything in crypto and hope. A calm, structured, step-by-step walkthrough of how to move from being a saver to being an investor, safely, intelligently, and at a pace that actually fits your life. Let's get into it. Why saving alone isn't enough. Saving money is the foundation. It's not wrong. It's necessary. But saving and investing solve two completely different problems, and confusing them is where most people get stuck. Saving protects you from short-term shocks, a car repair, a medical bill, a month without income. Investing grows your money over the long term so that it actually outpaces inflation and builds real wealth. Here's the problem. Inflation quietly eats away at cash sitting in a savings account. If your bank pays you 0.5% interest and inflation runs at 3% a year, your money is technically losing about 2.5% of its purchasing power every single year. You're not standing still, you're sliding backward just slowly enough that you don't notice. This is the single biggest reason people need to make the leap from saving to investing, not because saving is bad, but because saving was never designed to grow wealth. It was designed to protect it. So the question isn't, should I save or invest? It's, how much should I keep saved? And when do I start investing the rest? That's exactly what we're going to walk through. Step 1. Build your safety net first. Before you invest a single dollar, you need an emergency fund. This is non-negotiable, and skipping this step is the #1 reason people panic sell their investments at the worst possible time. Here's the target. 3 to 6 months of essential living expenses, sitting in a high-yield savings account or a similarly liquid, low-risk place. Not investments, not stocks. Cash you can access within a day or two if life throws something at you. Why does this matter so much? Because if you don't have this cushion and your car breaks down, or you lose your job, you'll be forced to sell your investments, possibly at a loss, just to cover an emergency. That single bad timing event can undo years of investment growth. Think of your emergency fund as the foundation of a house. You don't put a roof on a house before you've poured the foundation. Investing is the roof. Saving is the foundation. Build it first. A practical way to calculate this: take your essential monthly expenses, rent or mortgage, utilities, groceries, insurance, minimum debt payments, and multiply by 3 for a baseline, or 6 if your income is unpredictable, you're self-employed, or you're the sole earner in your household. Once that number is sitting safely in an accessible account, you are ready to move to Step 2. Step 2. Clear high-interest debt. This step trips people up because it feels counterintuitive. Shouldn't you be investing as early as possible? Here's the math that changes minds. If you're carrying credit card debt at 22% interest, and you're considering investing in the stock market, where the historical long-term average return is around 7 to 10% a year, you are mathematically better off paying down that debt first. There is no investment that reliably beats a guaranteed 22% return. And paying off high-interest debt is exactly that, a guaranteed return equal to the interest rate you stop paying. The general rule: if the interest rate on your debt is higher than what you could reasonably expect to earn by investing, typically anything above 7 or 8%, prioritize paying it off before investing heavily. Lower interest debt, like a mortgage at 4% or a student loan at 5%, is more of a judgment call, and many people choose to invest alongside paying that off slowly. This step isn't about avoiding investing forever, it's about sequencing. Debt at 20% interest is a fire. Put it out before you start building anything else. Step 3. Define your goals and your timeline. Now we get to the part where saving and investing officially diverge. Before choosing what to invest in, you need to know why you're investing and when you'll need the money. This matters because time horizon determines risk tolerance. Money you need in 1 or 2 years for a house down payment, a wedding, a planned move should not be in the stock market. Markets can drop 20 or 30% in a bad year, and if you need that money on a fixed timeline, you can't afford to wait out a downturn. Money you won't need for 5, 10, 20 years or more, retirement savings, long-term wealth building, can absorb short-term volatility because you have time to recover from dips. So step 3 is simple but crucial. Write down your goals, and next to each one, write down roughly when you'll need that money. Short-term goals. Under 2 years, keep this money in cash or cash equivalents. Savings accounts, money market funds, short-term CDs. Medium-term goals. 2 to 5 years. Consider a conservative mix, mostly bonds with a small stock allocation. Long-term goals, 5+ years. This is where real investing happens, with a heavier allocation towards stocks and other growth assets. This single exercise, sorting your money by timeline, is what separates thoughtful investors from people who panic during the first market dip because they invested money they actually needed next year. Step 4. Understand your risk tolerance. Risk tolerance is not a personality trait you're born with. It's a combination of your financial situation and your emotional relationship with uncertainty. And it's something you can assess honestly before you ever put money into the market. Ask yourself 3 questions. First, how would you react if your investment dropped 20% in a month? Would you sell in a panic, or would you shrug and wait it out, understanding that markets recover over time? Second, how stable is your income? Someone with a secure, predictable paycheck can typically afford to take on more investment risk than someone with unpredictable freelance income, because they have less need to access their investments unexpectedly. Third, how long until you need this money? We just covered this in the last section, but it directly feeds into risk tolerance. More time means more room to recover from volatility. Once you've honestly answered these questions, you'll generally land in one of 3 risk categories: conservative, moderate, or aggressive. This isn't about ego. It's not cooler to be aggressive. It's about matching your investment approach to your actual situation so you don't make emotional decisions later. Step 5. Learn the main investment vehicles. Now for the part everyone's been waiting for. What do you actually invest in? Let's go through the main categories in plain language. Stocks represent ownership in a company. When the company grows and profits, your shares generally become more valuable. Stocks offer the highest long-term growth potential but also the most volatility in the short term. Bonds are essentially loans you give to a government or corporation, and in return, they pay you interest over time. Bonds are generally more stable than stocks but offer lower long-term returns. They're often used to balance out the volatility of stocks in a portfolio. Index funds and ETFs are baskets of many stocks or bonds bundled together. Instead of picking individual companies, you own a small slice of hundreds or thousands of companies at once. This is one of the most beginner-friendly ways to invest because it automatically diversifies your money, reducing the risk of any single company tanking your entire portfolio. Mutual funds are similar to index funds but are often actively managed by a professional, which usually comes with higher fees. For most beginner and intermediate investors, low-cost index funds tend to outperform actively managed funds over the long run. Once fees are accounted for, real estate can be direct, buying property, or indirect, through real estate investment trusts, often called REITs, which let you invest in real estate through the stock market without buying physical property. Retirement accounts, like a 401k or an IRA in the United States, aren't a separate asset class. They're tax-advantaged containers you can put any of the above investments inside. This is a distinction beginners often miss. A 401k isn't an investment itself. It's a wrapper that holds investments and gives you tax benefits. The key takeaway from this section: you don't need to master every single one of these. Most successful long-term investors build a portfolio using just a handful of low-cost index funds or ETFs, spread across stocks and bonds according to their risk tolerance. Step 6. Start small and automate. Here's a mindset shift that makes the transition from saving to investing far less intimidating. You don't need a large lump sum to begin. Many investment platforms allow you to start with as little as $5, $10, or $50. The goal at the start isn't to invest a fortune, it's to build the habit and get comfortable with how investing actually feels, including watching your balance go up and down. The most powerful tool here is automation. Set up an automatic transfer from your checking account into your investment account every payday. This is often called paying yourself first. When investing is automatic, it stops depending on willpower or motivation. You're not deciding every month whether to invest. The decision is already made. This approach also naturally takes advantage of something called dollar-cost averaging. Instead of trying to time the market, which even professional investors struggle to do consistently, you're investing a fixed amount regularly, buying more shares when prices are low and fewer when prices are high. Over time, this smooths out the ups and downs and removes the emotional guesswork of trying to find the perfect moment to invest.